We are so pleased to continue our dialogue today, and we have some outstanding individuals who will brief you on a number of major considerations that have very meaningful importance relative to illicit transfers and the use of new financial capabilities. We would like to begin today with our panel on blockchain and Bitcoin illicit finance. If the following individuals could come forward, Mr. J.C. Boggs. He's the co-lead of Fintech, blockchain, and cryptocurrency practice at King and Spalding. Mr. Boggs, give him a wave. Beyond that, Mr. Boggs is on the board of the Parliamentary Intelligence Security Forum and has been a very strategic partner with us, as has King and Spalding, as they counsel governments throughout the world on public policy issues. So thank you, JC, for your extraordinary leadership in behalf of the Parliamentary Intelligence Security Forum. Also with us is Patrick Campos. He's a Chief Strategy Officer with Securrency. Jackson Mueller, the Director of Policy and Government Relations with Securrency. And Seth Hertlein, Head of Policy and Government Relations with the Stellar Development Foundation. Gentlemen, thank you for your good counsel, and we look forward to your remarks. Please proceed.
Hello? Oh,
yes,
okay.
You can pull them out.
Yeah.
You can pull them out and hold it.
You can pull it out, right? Need more hands for this. There we go. All right. Good morning, everyone. Welcome to the second day of our forum. It's been great to connect with a number of you during this event, and hopefully I can meet more of you as the day goes on. Just a couple things before we start this panel. A big thank you to Congressman Pittenger and his team in setting this up. It's been a fantastic forum. This is my first time in Panama, so really appreciate the invite, and looking forward to a great session today. And in particular, another big thank you to Lucas Rojas, who's been phenomenal and really dealing with an incessant amount of emails from me over the past several weeks. So big thank you to Lucas. My name is Jackson Mueller. I'm the, as the Congressman said, I'm the Director of Policy and Government Relations for Securrency. And before I get into, I'll have my colleague, Patrick Campos, over here describe Securrency in a little bit. But really, before I begin, I wanted to focus on kind of the topic of this panel, right? We're looking at blockchain, Bitcoin, illicit finance, and really, you know, my role today and the absurd amount of questions that I'm going to ask towards my panelists over the next hour and a half is really going to focus on the role of emerging technologies and alternative forms of value in both mitigating but also enabling illicit financing. And I think those two words, mitigating and enabling, are very important for this discussion. And it's not just here that we're talking about it. It's around the world. Various governments that, especially that we're tracking, are talking about these issues, and in what ways these alternative forms of value and these underlying digital systems and networks are actually facilitating illicit finance, or in many cases they're actually mitigating it. And so we'll get into those discussions in a little bit. Just to give you a preview of really what we're going to focus on, I've asked the panelists to first provide us with a foundational understanding of what these new forms of value and really the technology that underpins that value means for ongoing efforts to protect investors, consumers, and then the broader financial services ecosystem. We'll also talk a little bit about the political and regulatory reception to these emerging technologies, and really the fundamental importance of balancing both financial privacy with financial transparency. And last but not least, how and why the traditional financial services ecosystem is really beginning to look at these alternative forms of value and these underlying technologies that underpin this value, and why they're embracing this technology, and really what this means for the future of finance. As moderator, I'm not supposed to talk this much, so I will stop there. But without much further ado, I'll have the panelists introduce themselves a little bit further from the Congressman's remarks. So, JC, let me start with you, and then we'll go down the line.
Thank you, Jackson, and good to be here. And I've enjoyed meeting so many of you over the last couple of days, and I've learned a heck of a lot. So hopefully you'll pick up a few things today as well. As Congressman mentioned, J.C. Boggs, I'm with King & Spalding, Washington office, a law firm with 22 offices around the world. And pleased to be on you mentioned, on the board of the Parliamentary and Intelligence Security Forum. It's been an interesting year with COVID and the pandemic, but we didn't stop. We didn't slow down. We actually sped up and had, I think, maybe 22 webinars in the last 15 months, so just tremendous. And lastly, came to Washington in the late 80s, early 90s, and worked for the U.S. Senate on the Senate Banking Committee. So I've been doing banking work for a long time and seen its evolution from kind of more traditional banking to what you see today, what we'll talk about in cryptocurrency. So thank you.
Good morning. My name is Seth Hertlein. I'm the head of policy and government relations with the Stellar Development Foundation, which is a U.S.-based nonprofit focused in the blockchain space. And it's my first time here in Panama, and also first time with the Parliamentary Intelligence Security Forum. So I'm very honored to be here, and can't wait to talk a little bit further about blockchain. Sure. Will do. Thanks.
Good morning, Patrick Campos. I'm the Chief Strategy Officer for Securrency, as Jackson mentioned. And Congressman Pittenger, just want to thank you again for giving us the opportunity to be here. I've actually spoken one time previously to the forum in a virtual session, but this is the first time sort of live, and it's actually good to be around people. So Securrency is a blockchain-based financial markets infrastructure technology company, really focused on building sort of the next generation of financial services infrastructure, really based on the principle that there's an efficiency or an optimization of what we call financial logistics that can be brought to the financial networks to really reduce a lot of the friction and the cost involved. And a lot of that has to do with compliance, the cost of compliance. So we look at automating business logic and automating compliance functions to really streamline and make transactions occur in real time, and taking advantage of the power of blockchain, and a lot of what the benefits of blockchain that Senator Cassidy mentioned yesterday during his presentation. That's a lot of what we're focused on.
Great, thank you all. And again, I got to apologize to you guys, because as most of you will be made aware of this over the course of our discussion, my questions are very heavy and quite loaded. There are about 3 or 4 questions in each one of my questions, so let me apologize to all my panelists up here before we even get into this. But let's talk a little bit about kind of laying the foundation, really the foundation for this discussion. And the title of this panel is blockchain, Bitcoin, and illicit finance. And I think what would be helpful to kind of all of us in the room, and even before we get into a discussion on the mitigating and enabling factors related to illicit finance, is to get a sense from each of you as to why it's important that even though these are similar, right, blockchain, Bitcoin, it's important from a regulatory and policy standpoint to really separate the crypto asset from its underlying technology. And let me start with you, Seth, and in particular, focusing on Stellar Development Foundation, which is funded by Stellar Lumens, otherwise referred to as XLM. XLM is one of the more than 2,000 crypto assets that are now out there and available in various markets. The Stellar Consensus Protocol is really the underlying technology that supports the movement of value across borders and conversion to both fiat and other forms of crypto assets. Just help me and the rest of us understand the distinctions between the two, and why it's important that, as policy and regulators really start thinking about this space and look to apply some enhanced regulatory structures around some of this activity, that they need to consider these distinctions between the two. Thanks.
Thank you, Jackson. So this sounds to me like the classic blockchain but not crypto debate. I'll indulge you for a moment on that, but I think first I need to make some distinctions, and I think I'll use Stellar as an example to explain this. So, as I mentioned previously, Stellar Development Foundation is a U.S. nonprofit that's dedicated to increasing financial inclusion and access around the world. The primary way that we do that is by supporting the growth of the Stellar network. Stellar is an open source blockchain that enables cross-border payments, such as remittances, that settle in 3 to 5 seconds and cost fractions of a cent. And for countries in which a significant percentage of GDP comes from remittances, you can see the value proposition of Stellar's technology. So Stellar really makes the financial system more interoperable by connecting it on an efficient global payment rail, which we really haven't seen before blockchain technology. So now that you have a sense of what Stellar is and what it does, you may have noticed that at no point in that description did I mention Lumens or XLM, which is the native crypto asset on the network. And there's a very good reason for that. So while Lumens play a very important role in the functioning of the network, they're not really the point. So let me explain. The majority of value that is transferred or exchanged across the Stellar network is fiat to fiat in the form of an exchange of one fiat-backed stablecoin for another. Sometimes lumens serve as an intermediate step in such an exchange, and it's really just to provide the lowest cost path for the users. So that and network security are the two primary functions of XLM on Stellar, and both of those functions can be served, perfectly well, sort of irrespective of the trading price. And so we just don't spend a whole lot of time worried about lumens themselves. And so I think that's where we start to see a disconnect between what we as innovators and builders in the blockchain space, sort of how we view the network, and how regulators see it. And I think that disconnect is that while we're focused on financial inclusion and remittances, those aren't the most exciting topics in the world. And so I think there's a tendency for regulators and the media to sort of get distracted by the shiny objects of financial crime or price speculation, and sort of lose sight of the real purpose and benefits of these networks. And so for a regulator, I think there's a tendency or a temptation to overestimate the risk or the potential for harm with these new technologies, while underestimating the utility and the benefits that they provide.
Great, thanks, Seth. One of the interesting things, Patrick, about Securrency is the fact that it's ledger agnostic, and I think that's really interesting in this space in particular, because when I go on Twitter every day, I'm hearing from the Ethereum maximalists, I'm hearing from the Ripple maximalists, everything should be on our network. Securrency has really taken a different approach to this, and so I'd be interested as to, what does that mean exactly in being ledger agnostic, and what are some of the unique differences, between these alternative networks that are sprouting up these days and have been around us for several years now. And in particular, I think for the rest of the audience here, what would be interesting is a discussion of the difference between permission networks and permissionless, and why really open permissionless networks is really the way to go as we move forward.
Yeah, thanks, Jackson. So, you know, I want to sort of frame this obviously in the context of this forum, which is, you know, how does this new technology either make it easier or more difficult, you know, to track illicit behavior, illicit activity in the financial networks? And so, you know, one of the things about blockchain is it is an immutable ledger. So when something happens, it's recorded, and it's recorded immutably. It cannot be changed. You see that something happens. We call this a state change on that protocol layer. So if you think about it in that context, it's actually, with an immutable record, you actually have a better sort of, let's call it a surveillance tool, for lack of a better word. What's missing from that is identity, right? So you have anonymity in these networks. So you can see that things happen, but you can't necessarily you know, see who is doing those things. And therein lies the, you know, the controversy in this balancing act that we have to, you know, we have to work out as between, you know, protecting societies and citizens, you know, and cracking down on illicit behavior, but also at the same time being very protective of privacy and human freedom. But getting to your question specifically, Jackson, and again, I don't want to get too overly technical here, but you know, that protocol layer, that blockchain layer, is sort of that base layer of activity, and then what you can do is you can, over the top of that, you can build apps. So you get into things kind of, you know, layer one is a protocol layer, then layer two is, you know, sort of another layer that helps to speed up the network, and then we're layer three. What that means is that we're actually able to interconnect these different blockchain networks and legacy systems, allow them to, you know, interoperate, and allow them to talk to each other. It also does something else that's particularly important for this forum, which is that it then allows for things, and we've worked on this with the Stellar Development Foundation as well, doing things like clawback of value, where there has been a fraudulent or an illicit transaction. And that's particularly important in the financial networks. In terms of permission versus permissionless, and again, this gets down to, right, this classic question of, you know, freedom and innovation, you know, versus, you know, security and integrity of markets, right? And it's not binary, it's a balancing act, right? So in a permissioned network, it's kind of a closed loop. You have a lot more sort of control, but you have a lot less innovation. Theoretically, you have more compliance within that because of the control that you have, but you have to restrict access to do it. On a public ledger, like Stellar, you're going to find a lot more innovation because it's an open network, because people can come in, it's easy to access it, people can come in and innovate, you know, from that protocol layer up. And you see that. That's what you see, you know, on Stellar and on Ethereum, is you see this sort of, you know, explosion of innovation that is really the strength of this space. So the question is, well, if I'm allowing that innovation and that access, am I doing that at the expense of security and market integrity? And our answer is no, right? That's what we've spent our time sort of building, is, you know, a system that layers over the top so that we can have that market integrity, we can have that compliance layer without, you know, pulling back on innovation and access. So we actually think that there are only a few circumstances that I can really think of in which a permission ledger would be preferable to a global public blockchain.
JC, let me turn to you now, because I want to kind of focus in on the regulatory and policy reaction to all this, and it's been pretty heavy, especially over the last, I'd say, 2 years in particular. But it just seems to me that everyone, you know, is coming out with a report and the like. So, what is it about crypto assets and really, distributed ledgers that's propelling, officials to react here, and why should they react, and in what ways are they reacting?
Well, thanks. That's a great question. So, I guess I'm a little old-fashioned. So when you regulate something or you legislate on something, I think it's important that the policymakers or the regulators actually understand what they're trying to regulate or legislate around. And that's not always the case. So this is still a relatively new technology. It's been around for a decade, 11 years. Went from 0 to 2 trillion in that 10 or 11 years. So fast growth, but people are trying to understand what this is. So what are we regulating and why? And the blockchain is really Internet 2.0 or 3.0. The internet itself is the transmission of information. Blockchain is more the transmission of value. And then Bitcoin, or cryptocurrency, is really one subset of that blockchain capability. So, and as Seth mentioned, it's really a promising technology, allows for faster, more efficient, more secure payment system. So what is it? Is this money or is it something else? So I think about the old parable, I think it's an Indian parable, of the blind man and the 6 blind men and the elephant. I think it's the theory of manifold predictions. And they've never seen an elephant before. Well, they can't see, but they've never encountered an elephant before. And one blind man feels a leg and said that's a tree trunk, and another feels the ear and it's a large fan, and another one feels a tail and it's a brush or a rope, and so forth. So really, it's just in the U.S. alone, the regulators have sort of taken a similar approach, and the Commodities Future Trading Commission looks at crypto assets and they say they're a commodity, and the IRS defines them as property, and the SEC in many instances says it's security, and FinCEN says, well, it looks more like currency to us. So they all have their unique regulatory perspectives, and there's really no hard and fast rules of the road or regulatory framework yet. And then outside the U.S., of course, that's multiplied. So every country has a different perspective on what this asset is, what this new technology is. And so it's been a somewhat piecemeal approach or regulation by enforcement so far. I think it's even in the interest of many of the companies out there now that we do have a better regulatory framework or guidance so they can operate in that. And it's then, as Patrick mentioned, trying to find the right balance. So some countries, I spoke with a number of the African countries a few months ago on this. Many of them have just banned cryptocurrency. Well, that's a kind of a simple way to deal with it. It might not be the right way. And China included in that, and I think Colombia. Others promote it through either no regulation or lax regulation, or considering their own government central bank digital currency, which we talked about yesterday. And then there's others, and I think the U.S. is among them, and trying to find the right balance. So between innovation and regulation. And as a first step, maybe we don't need new laws, but it's applying existing laws to this new technology. And I would guess 80, 90% of the time that works. They might have to think about it. But you look at currently AML, KYC laws, combating the financing of terrorism laws, sanctions laws, securities laws, applying those existing laws and legal frameworks to a new technology. Again, trying to find the right balance, foster an approach to enforcement that supports innovation and growth. And there's a lot, I think this whole area needs some channeling or directionality through guidance with lawmakers and regulators in an effort to normalize it. And you've seen some of that normalization through, on the business side with PayPal getting into the space, and they, I don't know how many, 22 million customers, it's probably a lot more than that, but so now it's easier for people who've been using PayPal as a method of payment to get into use cryptocurrency. The OCC, National Bank regulator in Washington last summer said that national banks can hold cryptocurrency in custody. So that normalized it more. And you see 6 states around the U.S. now, and Texas most recently adopted similar things for their state chartered institutions. So in other cases, what might cover sort of the things in the analog world does not necessarily apply to the digital realm. And so when I was counsel of the Senate Banking Committee, this is '94, the cool technology back then, I think, was probably ATM machines, you know, and we go get our cash out. Now today, people don't even use cash very much. They use their credit card, they use their Apple Pay or something similar. Not much on the cash side. So, and in that time, we had fax machines and scanners, and that's how we would send things around. Now with computers and all that, we had to actually pass new laws, and this is things we might look at for cryptocurrency, but for your e-signature. We had the Uniform Electronic Transactions Act and the e-sign Act to facilitate that. And now we can just do that on a document, send it without getting out off your desk and faxing something. So things change. So there may be some new laws that do need to be adopted or enacted. But again, I encourage folks, particularly lawmakers and policymakers, regulators, to really try to understand this new technology before they go forth and regulate or legislate. So thanks.
So to the folks in the audience in particular, JC mentioned a lot of developments in particular that are happening in the U.S. currently, both at the federal and state level. But it's not just the U.S. And in fact, we're monitoring a number of developments that are happening around the globe as it relates to developing these crypto asset regulatory and policy regimes. Some of the biggest that you're seeing right now is what's going on in Europe with the markets and crypto assets framework. In the UK, they just came out with their crypto assets framework. Australia is also moving towards a crypto asset framework at some point, we believe probably later this year. And then several other jurisdictions as well, ADGM, for instance, in their virtual asset framework. So there's a number of frameworks that are in development right now. And I say in development because when you look at the EU, for instance, and I was just listening to an earlier conversation among the Econ committee there, they've got more than 1,100 amendments that have been submitted to the markets and crypto assets proposal. So it's still a long way to go. There's a lot of discussion out there, but there's some really interesting developments, not just happening in the U.S., but also globally as well. JC, I wanted to take some of your comments and really get back to what I was talking about earlier and highlighting mitigating and enabling and how these technologies are both mitigating illicit finance activity in this space, but also enabling. And I think what's interesting, and going back to using the U.S. as an example, on the one hand, over the last several years, we've had industry stakeholders who have, been talking about how the underlying technology supporting these crypto assets and supporting the crypto asset marketplace overall brings significant transparency to these markets, right? At the same time, what you're hearing in the U.S. and around the world in various discussions is that these technologies are just simply enabling illicit finance at the end of the day. And emerging tech is just ending up promoting the bad guys and really not, destabilizing a lot of these financial services ecosystems. And I think what's interesting, is this contrast. On the one hand, industry is saying this thing. On the other hand, policymakers are saying the complete opposite. So, I'd like to hear from the panel here, and Seth, I'll start with you. But who's right in this argument, right? And who's wrong? And is there a right or wrong? And what's really not being discussed that really needs to be considered in these discussions? So Seth, I'll start with you, and then Patrick and JC, you can kind of tag along.
So I'm going to duck your question.
But I'll leave it to JC and Patrick to get into it. But before I do that, I think it's really important to set the table here with some facts and data. So there's one of the leading blockchain analytics companies is a firm called Chainalysis. And Chainalysis has a number of contracts with different US federal agencies. And they also publish every year a crypto crime report. In the most recent crypto crime report published by Chainalysis, they found that 1/3 of 1% of cryptocurrency transactions involved some element of criminality. 1/3 of 1%, a tiny fraction. The actual number was 0.0034. And so anyone who would suggest that a majority or that cryptocurrency is predominantly used for money laundering, for example, simply is misinformed. The data just doesn't bear that out. But you can actually extrapolate a little bit more from the data in that report. So that 1/3 of 1% of cryptocurrency transactions that were in some way illicit included all of the different ways that you could commit financial crime. So actually the majority of the crimes represented in that 1/3 of 1% were garden variety investment scams and things like Ponzi schemes. And while Ponzi schemes are certainly undesirable, that's sort of not what we're here to talk about today. And what that means is that only a tiny fraction of cryptocurrency transactions involve money laundering or terrorist financing. And so I don't say this to suggest that we should all just ignore it or that it's not a legitimate problem. But I would push back against some of the knee-jerk reactions, some of the knee-jerk policies that we've seen from various policymakers around the world. In relation to money laundering and cryptocurrency, that based on the data, is a disproportionate response to the scope of the problem.
Just jump in real quickly and build on that. In contrast to the whatever the percent is, well under 1% or 0.5% or less than that, the illicit activity in the economy as a whole through traditional financial intermediaries or traditional fiat currency is in the order of 2 to 4%, so a much higher number.
Yeah, so I'll jump in on this one as well. So I start with this premise, and at a previous forum I said this, and it's worth repeating, which is let's really make sure when we're talking about policy relating to whether it be cryptocurrency or blockchain, that the policy we're describing is the actual policy that we mean. And what I mean by that is, it's my observation that if you have some other issue with crypto, for example, like if you think crypto poses a threat to monetary policy, it's easy to just say, well, it's used for terrorist financing as a shortcut to addressing the real issue, which if you think it has an effect on monetary policy, address that issue. More importantly, I think this is the approach that I would advocate. Number one, certainly, don't throw out the baby with the bathwater, meaning that there's a lot of innovation that is being done in this space, and it's in whatever country you are, whether it's the United States of America or any other country, if you stifle innovation in that country, you're not stifling innovation globally. You're only slowing your own entry into a market that is actually the future. I think that serious countries are not conflicted on the question of whether blockchain technology is going to form the backbone of their financial infrastructure. Serious countries are not conflicted on this point. China's not conflicted on this point. China's building a blockchain services network to integrate with their digital yuan and everything else. So the notion that somehow you can just label something bad and then say, well, we'll kind of, stuff it back into the closet, I think is a false one. However, it is certainly true that the the crypto and the blockchain community needs to engage very seriously on these issues of illicit finance and nefarious activity, because it is certainly true. I think it's been said previously in this forum that the ease with which you can move vast amounts of value cross-border in a matter of seconds is one that bears, it's worthy of serious attention. The question really is, how do you achieve that? And I would make an argument that really getting ahead of of that impulse that's driving the innovation right now, right? So what I mean is, a lot of the innovation is a result of the fact that people, who have gotten involved in this really, recognize that they can profit. There is a profit motive that underlies a lot of, not every bit of innovation, but a lot of it. There's a profit motive that underlies it. And what we've observed is that as sort of companies become sort of more adept at using these, they become more institutionalized. In other words, the more innovation there is, the more of a tendency there is for the industry to move towards compliance, not away from it. Does that mean that everybody is in that space? No, absolutely not. But it does mean that there is a real need for engagement as between the communities. For policymakers to treat the blockchain community or the crypto community as sort of a fringe element outlier is to miss the point. And actually, there is a need to engage with it. From our perspective, there's a need to preserve the private sector influence and not sort of co-opt it. I mentioned China earlier. I think China is co-opting all of this, sort of in the public sector, and that's not a model that we would advocate. We think it's actually a very bad model. But really, and it's been said before in this forum, a kind of a public-private partnership. So to your question, who's right and who's wrong, I hate to give a namby-pamby answer like this, but it's not that easy, right? It's, we certainly recognize a need for, for compliance in the space, and we need and oversight in the space, but not at the expense of innovation and not at the expense of privacy.
So let me just add to that. There's certainly, there's good uses and bad uses of any technology, right? So here, the illicit uses of cryptocurrency generally fall into three categories. So using cryptocurrency to engage in criminal activity through financial transactions. So examples include financing terrorism, sales of illegal substances, and extortion. Second, using cryptocurrency to conceal criminal financial activity. This includes money laundering, tax evasion, and avoidance of other legal reporting requirements. And thirdly, committing crimes against the cryptocurrency marketplace itself, such as hacking, theft, phishing, to obtain cryptocurrency illegally from victims. On the positive side of the ledger, I don't think there's enough discussion about this, is blockchain technology is a powerful but underutilized forensic tool for governments and law enforcement to identify illicit activity and bring criminals to justice. It's easier for law enforcement to trace illicit activity using Bitcoin than it is to trace cross-border illegal activity using traditional banking transactions, and far easier than cash transactions. So when it comes to transparency in the international financial system, cryptocurrencies provide enhanced opportunities for law enforcement agencies to be able to trace transactions. And the chance of catching illicit actors is magnitudes greater using blockchain than in the traditional banking sector. I think that's really important to recognize. One blockchain analytics expert went so far as to say, if all criminals use blockchain, we would wipe out illicit financial activity. So its transparent nature led another expert to compare transactions on blockchain to having the whole world be witness to paying someone $2,000 in a dark alley. So blockchain technology enables this forensic power because it captures every single transaction for all to see. It provides governments and public at large with a permanent, unchangeable record of transactions. So perhaps the biggest threat involving cryptocurrencies is not illicit finance, but rather that governments do not fully understand the power of blockchain as a tool for law enforcement and intelligence agencies. Beyond the United States, blockchain forensics are being used in government agencies in Europe, Japan, South Korea. There's a gradual recognition that helps explain that the significant legal cases that have been broken through the use of blockchain analysis. So significantly, last November, the IRS was able to retrieve $1 billion worth of illicit Bitcoin related to the now defunct Silk Road darknet market. And then also last year in July, there was a breach of the Twitter's network where over 100 high-profile accounts in a Hollywood set were hacked to promote a scam asking followers for Bitcoin. It only took 2 weeks for investigators to identify the perpetrators and make arrests. The investigators linked the wallet addresses to user accounts on various forums. Then using blockchain analytics, they traced stolen funds to various exchanges, work with those exchanges to identify the users, and match that user information to the data found on the forums. And notably, investigators identified an individual who never posted anything publicly that could link him to his real-world identity by analyzing transactions between Bitcoin addresses. And more recently, we saw this with the Colonial Pipeline, what do you call that, situation in the U.S. where they shut that down, asked for $4.4 million in Bitcoin to provide the software to enable the pipeline to run again. This was it was a dark side criminal hacking group that took credit for this. The FBI, within a month, less than a month, recovered most of that money. So some people say blockchain solves everything. I don't know if that's true, but it does solve a lot.
So let me kind of ask a follow-up question to this, and I think the industry, and correct me if I'm wrong here, guys, but the industry has said recently, and as far back as I can remember, that look, illicit financing isn't really happening in our markets. Look at the traditional markets. It's massive amounts more there. It's only happening. It's barely happening in our markets, but I guess if I'm industry and I'm going in to a policymaker's office or to a regulator and saying, hey, look, our industry isn't as bad, right? That still doesn't convince me at the end of the day that what your industry is doing is good and okay, right? And so I'm trying, feeding off of your remarks, feeding off of JC's remarks, and what does the industry have to say, to kind of change their dialogue on this?
Yeah, I'll jump in on this one, Jackson. So I think that there's a lot of validity to that position, which is, and it's based on this. The idea is to regulate the behavior, not the technology. And I think, it was a statement that was made yesterday, very eloquently about, just because something is complex and because you don't understand something is not necessarily the reason to sort of, shut it down or treat it differently. And I think that's the main point that industry is making. Now, look, I'm going to be very honest. There are a lot of people who are, in the space because they can make a quick buck. It's still, the crypto trading is still an unregulated space in most cases. And the volatility of a number of assets means that there's a lot of money to be made. There's huge spreads, a lot of money to be made, and there are a lot of folks who are just like, look, I'm making money and I just, don't bother me with that. But let me show a different side of this. You mentioned Chainalysis, and Chainalysis is a company that is basically dedicated to really market surveillance, if you will, or really more specifically AML on blockchain networks. It's a big company. It's a very well-funded company. It's a very well-known company. And why is that? Because the industry recognizes that it needs this capability. This is coming, yes, it's a response to regulation, but it's innovation that's being driven from within the community itself. And it's innovation that is, responsible. You see the rise of a number of custody-focused companies focused on the custody of digital assets. And I do want to make a quick note that, we are, as a company, Securrency, we're really focused on digital securities. That is taking traditional securities and putting them in a digital format so that they can move in legitimate transactions in a fully compliant way instantaneously in cross-border scenarios. So back to custody, why? Because this is something that is really required for institutional grade transactions in digital assets and cryptocurrencies. Meaning that, again, back to my original point, it's the profit motive that has really drawn people into the compliance space, right? Because these custodians are, they are there to respond to regulatory requirements. That's their purpose there. So, we see this, and I think that, again, to your question, there's a legitimate response. That just simply looking at new technology and saying this is scary and only bad guys use it, which, by the way, we've heard people like, Janet Yellen or Elizabeth Warren make statements like that are they're so stark and they're so wrong in terms of, looking at the entire technology and saying, oh, well, it's mainly used for bad. I mean, that's no different than looking at fiat currency and saying, let's abandon fiat currency because there's a lot of illicit behavior out there. If that's the way you want to look at it, if you only want to focus on that, you could arrive at that conclusion, but it's an impoverished view. And that's sort of the way that we look at it.
So I'll continue on those thoughts, Patrick. And to answer your question, Jackson, if we're walking into a policymaker's office, and we're saying, we'll look over there. There's more illicit finance in the traditional financial sector or in fiat currency versus.
Right.
If that's your argument, you're just saying we're less bad. You're losing, right? That's not a compelling story. And so I think as an industry, what we need to do a better job of is sort of flipping that script and doing a better job of communicating the benefits and the real world uses and the utility of the technology. And so to pick up on something that you said, Patrick, you alluded to this a little bit with fiat, but I'm going to borrow a story you told me one time that I really liked. So once upon a time, in the American West, it was very common for trains to be robbed. It was also very common for banks to be robbed. And certainly one of the ways that you could prevent train robberies and bank robberies was to ban railroads and banks. But nobody ever suggested that. Why not? Well, because it was obvious the value of railroads, and it was obvious the value of banks. And so that was never contemplated as a potential solution. Why is banning being contemplated by serious-minded people with respect to cryptocurrencies? I think the answer is because it's harder to communicate the value because it's so technical. And so that's what we need to do a better job of is explaining those benefits. So it's harder to it's harder to sort of get there as a potential solution.
So I gotta move on and get to the bigger elephant in the room, and it covers the issue of transparency and privacy, and it follows from this mitigating and enabling discussion that we've had, and in particular, I think this is kind of almost a bigger part of the equation here, and Patrick, JC, and Seth have touched on this a little bit during their discussion. But Seth, let me turn to you again, as being the point person for all my questions. I apologize, but
lucky day.
But I briefly touched on how industry, again for years now, has continually spoken about the transparency and the benefits to market integrity from adopting distributed ledger technology, and then I've also said, well, as soon as policymakers and regulators attempt to shine more light on this space, the industry starts screaming about potential violations of privacy and as it relates to financial accounts and other financial information. And so, on the one hand, the industry is talking about transparency, but then on the other, they're advocating against efforts to unmask, certain financial information that could be useful for various law enforcement purposes. So is that a fair analysis? And in particular, is there an effective balance between transparency and privacy in this space so that we don't, the balance of the seesaw kind of stays the same versus kind of tipping it? I'd love to hear kind of your thoughts on that.
Yeah, it's a great question. I really think that is the issue, right? Transparency versus privacy, in a sense, is the reason that we're all here today. It's a reason that the forum exists. And while I suspect that most of the folks here and most of the folks tuning in, would probably lean toward the transparency side of the spectrum, the reality is that it's very context-based. It's not that simple. So here's a crude example, right? So Patrick, say that you're in the market for some new windows, and I'm selling windows, and so I offer you a shiny new crystal clear window and an old cloudy one. Which one do you pick?
What was the second option?
An old cloudy window.
Pick the clear window.
Well, obviously, of course you'd pick the clear window. But what if the window that you need is for your bathroom?
Good point.
Right, so context matters.
That's a little personal. I don't know.
It's open for debate.
So my point is context matters here, right? So, sometimes transparency is more important. Sometimes privacy is more important. And, so fortunately, this isn't new ground. This isn't new territory. It reminds me of a debate, that we had in the early days of the internet. So I hope you're all in the mood for a history lesson because I'm going to tell another story. So in the early days of the internet, the basic protocol that the internet ran on is called HTTP. And HTTP was a revolutionary innovation, but it had one critical flaw, and that was HTTP was not encrypted. And so if it's not encrypted, that means that it wasn't private, and if it wasn't private, that means it wasn't secure. And this started to become a real problem with the advent of e-commerce, when people started typing their credit card numbers and their bank account numbers into websites on the internet. And so because HTTP wasn't encrypted, anybody with a little bit of technical know-how could basically intercept your internet traffic, could snoop on everything that you were doing online, and that posed real problems. And so the solution, to this was an upgrade to that protocol, which is called HTTPS. Colloquially, the S sort of stands for secure. And that security comes from encryption. So now the traffic between your computer and the web server that you're interacting with is encrypted if you use HTTPS. And at the time, law enforcement cried foul. They said, well, how are we going to catch the bad guys if all of their online traffic is encrypted now? And undoubtedly, that probably did make things a little bit harder for law enforcement in some cases. But here's the important part. It actually prevented far more crime than it enabled, because it also blocked the bad guys from being able to access your information to commit the crimes in the first place. So that's an example where transparency isn't always good, right? Sometimes privacy means security, and sometimes privacy can actually prevent more crime than it enables.
So, Patrick, let me turn to you to really dive in a little bit to Securrency's approach to this, and really the critical need to enhance the transparency of digital transactions, while at the same time respecting an individual's right to privacy, financial privacy in particular. And of course, because of my questions, this is a multiple question. But a big concern in using emerging technologies to fight illicit financing is the very real potential for regulatory abuse and overreach. And I think that's a huge issue that really, until recently, hasn't really been discussed. So how does Securrency's platform protect against this very real concern?
The concern of regulatory overreach?
Yes.
So
Finding that right balance again, but then also talking about, well, what happens if that balance is abused?
yeah, so well, look, I mean, in a very real sense, what our technology does is to enable market participants to be compliant with the regulations as they exist in a particular jurisdiction at a given time. Or more specifically, because we're looking, we look ahead to a world sort of with giant global liquidity pools, or even a giant global liquidity pool, where it's all very interconnected. Because right now, liquidity is restricted because you have to keep things in certain silos. And those silos are largely mandated by regulation. So sometimes it's a national silo because you have to place restrictions upon the movement of value, in this case securities, but other types of value across national borders. Even within national borders, you have silos. You have a silo, for example, you say, well, these are the private markets and these are the public markets. Why? Only because, for investor protection reasons, we say, well, if you're a sophisticated investor, you get to play over here, and if you're a non-sophisticated investor, you have to. That's a regulatory-driven thing. Now, we don't make a statement as to what the investor protection standard should be. In other words, that's a policy issue, that's not a technology issue. So you see a lot of work being done around changing the definition of accredited investor. Is it a wealth test? Is it an education test? It's a policy issue, that's not our issue. The way that we look at it, though, is whatever that test is, it can be automatically enforced through attributes-based dynamic compliance, automated compliance. So what does that mean as a practical matter? For the audience listening here, this is what I mean by that. Is if I go into a store, and let's say it's a giant supermarket, and there's all sorts of products, but certain products are off limits to me. For example, if I'm not 21 years old, I can't buy alcohol in many jurisdictions. They don't say you can't go into the supermarket because you're not allowed to buy alcohol. They say you can go into the supermarket, you can see everything, but there are some things you cannot buy. That means if you're able to enforce that in an automated way, then you don't have to segregate these marketplaces, and you can really bring markets together, tear down the silos, and create global liquidity. And so actually that's the way that we look at compliance. We're not writing the rules, but we're creating tools that allow market participants to comply with the rules as they exist in a very, very streamlined way. Now that has significant implications, obviously, for the movement of value. You can now, and I think, as we, maintain our focus on, really cracking down on illicit behavior, we automate in that process, and we use third parties to do this. So you automate that entire onboarding process, the KYC and the AML, and now you have known participants who are qualified to engage in certain transactions, and you have a great deal, as JC said, a great deal of transparency as a result of the way those networks, record that data, and you've got a global marketplace. What's not to like, right? It's really, this is powerful and it's fast. It brings an efficiency to the markets that is, hasn't been seen before, which has huge implications for capital formation. It has huge implications, obviously, for liquidity, and it has huge implications for global financial access. In fact, to sort of expanding on my previous point, it will encourage more people to become banked, to get into the clear, so to speak, as opposed to staying outside of the traditional networks and in the shadows. And I think that that's a really important overlooked aspect of the technology.
JC, I wanted to turn to you on this, and again, going back to my comments from earlier, and then comments that have been shared by Seth, Patrick, and yourself. We're seeing multiple regulatory jurisdictions and multilateral organizations really make some coordinated, if not coordinated, some serious efforts on the anti-money laundering and know your customer front. And in particular, one of the Financial Action Task Force in particular, among others, to really enact kind of global standards to combat illicit financing. And we just got through FATF's plenary session last week, where they're going to decide in late October as to where to on the final rules as it relates to travel rule compliance. What's the outlook here? And as we look ahead to the near term, and I've got to say near term because if I say long term, 5 to 10 years from now, it's all going to change. So next 6 to 12 months, where are we headed, especially as it relates to AML, KYC compliance, and the like?
Yeah, well, so I think you had a lot of the answer in your question too. So thanks for that. There's definitely more global cooperation, coordination around this as there needs to be, and they haven't quite settled on. I guess they had was it a meeting last week?
Last week, yeah.
And kind of punted down the road a little bit, but I think we're going to see something. I would say in the next 3 to 6 months. I know you followed this. We talked about this morning. But you definitely see more international coordination on a range of laws, and how sort of back to the privacy thing. How do existing laws like GDPR, it really doesn't fit so well, because I think under that you have a right to be forgotten or certain privacy. Well, this is in blockchain indelible, so I don't know how you remove information, because it's not in one central computer. It's all over the place in nodes, thousands and thousands. So you could change one, but you can't change everybody's, right? So we're going to have to adjust some laws here and there.
So
can I add something to that? Because it's actually a very important point, because we assume, and FATF and the travel rule, everything assumes that it's all based on identity, right? And that's precisely where you run into these issues of privacy versus transparency. But I would posit that the strength of blockchain networks, and JC, the point that you made earlier about how you can see everything that's happening, you marry this to AI ML, and you say now instead of being identity based, you can be surveillance based, and even anticipating the behavior, right, and really being proactive instead of reactive to a lot of this stuff. So I think that what will come out of this is new ways of thinking about KYC, AML, and not being completely reliant on identity based, so you can preserve privacy, but you can still maybe even do a better job of deterring illicit behavior.
Yeah, I guess some of this too is how you could build this system in a lot of different ways, right? So, and you were talking about the internet example, HTML and HTTP. That didn't have encryption, they added it in later. Similarly, and you've got 2,000 cryptocurrencies, there are some different variations to that. But really the use case was around what Patrick referred to as this, the unbanked and underbanked, who don't need to go to a middleman, or don't have a bank, or don't want to go to the middleman and spend the extra money to move $40 across the world, and it's going to cost $30 at Western Union to do it. So this is really fast, efficient, secure, decentralized. So then it's on the other extreme, and this is maybe an oxymoronic kind of thing, is a centralized, decentralized ledger that the central bank digital currency is. So what kind of privacy when you have, we'll use the example of China, because they're really the farthest ahead on a central bank digital currency.
Gentlemen, sorry, we are almost done with the panel. So
last
maybe
question.
The last.
Okay.
Yeah.
I'll finish that. So you have transparency over everything. They can see every transaction, every payment you made, to who and for what it was and what it's for. Do you want that? And then maybe your behavior is not that good. They could say, well, we're going to close your bank account, or you're not going to be able to access that account for whatever reason. And you see some of this, even in the U.S., with sort of the deep platforming of companies that, well, we shouldn't, banks shouldn't be giving out loans to big oil companies or gun manufacturers. So there's danger of that when you have that transparency and kind of one entity with the strings. There's some danger in that. So I answered, totally went off the rails on that, but.
So my clock went from 15 minutes down to 3 minutes almost immediately. So I almost feel like Jack Bauer from the TV series 24. But let me
the lightning round.
Let me just end with this question because I think it's on the minds of everyone here. El Salvador. Let's talk about real quick. You know, their effort to adopt Bitcoin as legal tender. Obviously, we're seeing developments in Panama with legislation. I think it's being introduced in July that would do something to the same effect. What do we make of all this?
It's going to be a fascinating experiment, if nothing else. You know, but I think you know what's motivating is something, JC, that you just touched on, and you know, which is you know the problem of you know the unbanked, which I actually don't like that term. You know, but I think there's a significant problem. You know, so 1.7 billion people around the world don't have access to a bank or traditional financial services. You know, most of those people, or a lot of them certainly, have you know, access to you know, mobile phone technology. Maybe not smartphones, but feature phones. And you know, so some of these blockchain-based solutions provide real potential to reach those populations, to enable them to access financial tools and services that they otherwise you know, wouldn't be able to. And I think that's what's motivating you know, some of this in El Salvador. I think the statistic is 70% of the population there is unbanked. It's a high remittance country, and you know, remittances through traditional rails can be very costly and very slow and inefficient. So and I think there's a real potential for the technology to benefit countries like El Salvador, and I think that's why a number of others are taking a serious look at it.
Oh, no, I would just simply add to that I think that there are some really interesting implications for innovation and thinking through some of these issues. I don't think that the proposals that have been made are in and of themselves sort of, you know, internally perfect. I think there's a lot of work that needs to be done with some of that. But I think more importantly, it does point out these things are driven by a couple of things. One, an erosion in trust in institutions. You know, if you know, policymakers don't pay attention to that, they're missing a major point here. And that includes also an erosion in trust in some monetary policy issues, and including from our own country in terms of the U.S. dollar. And what does this mean? Why not just use the U.S. dollar? And I think that we need to look at these things and look at the broader implications, the motives behind them, and really take lessons away to inform policy making going forward.
Real quick.
It's going to be an interesting experiment to watch in El Salvador or other countries that may adopt something similar, but it'd be interesting to see the evolution of this beginning of the asymmetric disintermediation of existing banks, and how does that play out? So on that note.
Oh, there we go. Thank you to all my panelists. Really appreciate the discussion. I thought it was great and informative. Thank you to the audience for listening in, for those that are here and online. I'm sorry we didn't get to Q&A, but please do reach out to us if you have any questions. We are in the middle of all these regulatory and policy developments, and both institutional and industry developments. So please reach out to us, and thank you to Congressman Pittenger and the rest of his team for the opportunity. Thank you.